those excessively gracious words. I must say, when you speak at commanding heights, it reminds me the other day I was at a meeting with Jean-Claude Trichet, and he introduced me as too big to fail. But Victor, William, friends of the new Institute, this is indeed a wonderful occasion. It's time to celebrate, but I was a little taken aback, Andrew, when you said it was time for a joyful occasion. I thought perhaps you picked the wrong speaker. I am an old central banker. I don't specialize in joy. And I will demonstrate that immediately, because I have to tell you, this event, this Asia Global, could change the world. But let me say, it's nonetheless a truly significant event. The Fung Global Institute is today a symbol. Tomorrow and the tomorrows that follow, it will become more than a symbol of both the intellectual and economic realities we face. Asia has been rapidly, to me almost unbelievably rapidly, moved from a seemingly dependent and exotic satellite of the so-called highly developed world to a major force in the world economy and political system. Within a generation, China alone, as you know, will be far larger economically than either North America or Europe. And if we take all of Asia together, it's not so long before it will approach the size of the United States and Europe combined. That is a genuine great leap forward. We all recognize that objective fact. But I have to tell you, it's also something that will take psychologically some getting used to. That's true at least to those of us who've grown up thinking of the Western world, and particularly the United States, as being naturally dominant. It will surely force adjustments in Asian thinking as well. Size and wealth imply new responsibilities, new attitudes, more particularly an open, outward-looking leadership. And all that's going to be required if we together ought to look forward to a peaceful and harmonious world. This Asia global dialogue can be one big step in accepting and adjusting to those new realities. And I have to say, I feel greatly privileged for the invitation to take part. Now, my role is to look ahead, to signal out elements in the financial and monetary system that need attention. Having written that sentence, I realize that makes for a very long speech. And you haven't had the first course, second course, third course yet anyway. So let me try to be a little bit brief. I don't have to elaborate the fact that we've all had plenty of evidence of financial stress and financial breaking down. First in Asia in the 1990s, and a decade or so later in the United States and Europe. We've both been vulnerable to breakdowns. The cost and interrupted growth and unemployment has been far too large to be tolerated. We simply can't accept failure in achieving sensible and needed reforms. The need has been widely recognized in the efforts underway nationally and internationally. Now, I don't want to review all that work in detail, but I do want to make a few points that need emphasis. First of all, if there is not an international consensus on some key points, the reform effort will be greatly weakened, if not aborted. Money, financial markets, and people are free to move to escape regulation and taxation. That is acceptable and even constructive as a break on excessive and heavy-handed official intervention. But it's simply not acceptable if in crucial areas a kind of competition and regulatory laxity develops at the expense of needed standards of ethical and prudential behavior. Common capital standards for commercial banks is a leading case in point. Given appropriate procedural safeguards, authority of regulators to intervene if needed in speculating forces that are running rampant, or if innovative financial instruments and so-called financial engineering become so complex and so opaque as to pose clear risk to stability. Better understanding of the clearing and settlement arrangements and other characteristics of the burgeoning world of derivatives. I am told that today there are, in total, internationally, some $700 trillion of derivatives outstanding in nominal value. That's another area where the implications are clear with respect to national borders. Now, perhaps most important is a coherent, consistent approach toward dealing with the imminent failure of so-called systemically important institutions. Taxpayers and governments alike are tired of bailing out creditors, even stockholders and management of failing institutions. They fear, quite rightly, destructive, contagious effects of failure, but the implication of that practice in encouraging excessive risk-taking is by now also widely understood. By law in the United States, new approaches superseding established bankruptcy procedures dictate the demise rather than the rescue of failing large financial firms. Demise rather by sale, merger, or if necessary, liquidation. But success in that effort will be dependent on complementary approaches elsewhere. Most critically in the UK, and I've been happy to see that there's been considerable constructive discussion between the American and the UK authorities in achieving a consistent approach in this area. Now, strict uniformity of regulatory practices in all respects may not be necessary. For instance, the UK and the US may be adopting approaches different in their specifics with respect to protecting commercial banks from engaging in more speculative and proprietary trading. The policy concerns are broadly similar. Those concerns may not be so pressing elsewhere, where banking traditions are different and trading historically has been restrained. But neither should those other jurisdictions act to undercut the restrictions imposed by home authorities. And I want to tell you, I personally would not mind at all if China and Hong Kong adopted something called the Volcker Rule. Now, those are matters that will occupy much of your attention during the dialogue, and I want to expand your thinking really into a closely related area of the international monetary system. You may legitimately question whether we have, in fact, something that is entitled to the title of a monetary system. Certainly it has been rather catch can since the demise of the Bretton Woods arrangement decades ago. None of the established international institutions, whether they're the IMF or the BIS, and none of the ad hoc committees and councils of financial authorities, ranging from a G5 to a G7 to a G8, now to the G20, have systematically and consistently been able to exert needed authority. There is, in fact, no officially sanctified and controlled international currency. Well, arguably, the ideal of a well-defined and effective monetary system becomes more difficult as markets and capital flows have become vastly larger and potentially more capricious. Indeed, the point is made that the world economy has grown, even flourished at times, in the emerging world without a more sophisticated and organized monetary system. Well, yes, that's been true for a time. But what, in my mind, has too often been overlooked is that the international monetary disorder lies at the very root of the successive financial crises of the 1990s, and even more strikingly in the more recent crisis. The example of the sustained imbalances in the United States and in Asia stand out. From 2000 to 2007, the United States ran a cumulative current account deficit of some $5.5 trillion. You know, in my day, I never talked about trillions of dollars. That shows how things have deteriorated in recent decades. We ran a deficit of $5.5 trillion. China and Japan together had reserve accumulation totaling close to the same amount. And that symmetry, if it's entitled to that word, was not accidental. China obviously found it useful and convenient to run large trade surplus as a means of supporting its industrialization and rapid growth. It generated both a very high rate of internal savings and a lot of inward foreign investment. The United States, in contrast, had much slower growth and stagnation in personal incomes. In those circumstances, it was content to sustain exceptionally high levels of consumption at the expense of personal savings. There's a certain symmetry in our savings behavior between China and the United States. We consume about 70% of our GDP. China consumes about 35% of its GDP, nicely 50% of what the United States does. In any event, those differences were bridged by an inflow of capital from China and Asia to the United States, and that inflow took the form of short-term dollars at extraordinarily low interest rates. The trouble, of course, was that the imbalances could not be maintained indefinitely. It came to an end with a massive bubble in the housing markets in the United States, a bubble fed by low interest rates related to the strong inflow of foreign money. The speculation ended not with a quiet and orderly adjustment, but with a very large and deeply disturbing bang. Unlike what we heard this morning from Chairman Louis, the economic Titanic did not miss the United States. I know it's a simplified account of a complicated story, but it does have a central element of truth. The practical and inescapable lesson is that when any country is left to its own policy devices and preferences, those preferences may lead to prolonged and ultimately unsustainable imbalances. Then sooner or later, adjustment will be necessary, if not by considered domestic policy, by a well-functioning international monetary system, then by financial crisis. And not so long ago, there was comforting theorizing that floating exchange rates, rather generally practiced, would themselves deal with the international adjustment problem and deal with it in a timely and orderly way. But I think we know now the real world has not been consistent with that theorizing. Nor, I must add, does it seem at all likely that refuge can be found in fixing exchange rates. We're thus left with the certainty, however awkward that certainty, that active participation in an open world economy with all the enormous benefits of international trade and investment requires some surrender of economic sovereignty. Or let me put the point more positively, there must be a willingness to find means of coordinating policies more effectively. And that is indeed the essence of a well-functioning international monetary system. Now, none of this is new ground intellectually or practically. What's been lacking is a determination to do something about it. Recent meetings of the G20 have in fact alluded to the need for fresh approaches. Some broad and potentially useful ideas have been set out, but it's also very clear that in the midst of more pressing economic and political problems, those ideas have had little or no traction. I can only plead that that not be the case with the Fung Global Institute. Now, permit me to make a few suggestions for your future work program. At the heart of the matter is, in the jargon, an effective international adjustment process. That's a natural concern of the IMF, as well as of the more informal groupings of the largest economies. But the approach of expert analysis, consultation, and peer review simply has been ineffective. National thinking and policy approaches are not compatible. No effective pressure is brought to bear to force consistency. In a word, discipline has been absent. What are the practical means of enforcing the necessary adjustment measures? I won't be either definitive or exhaustive, but let me suggest some of the possibilities. One, often talked about, is stronger surveillance by the IMF, a firmer commitment by nations to abide with best practices and agreed norms. Or we go further and have direct and public recommendations by the IMF to G20 or otherwise, following mandatory consultation. We could have qualification or disqualification with respect to the use of the IMF or other credit facilities, such as central bank swap lines. We had approaches along those lines, none of which have been very effective. We could go on and have penalties, financial penalties, in the form of interest rates, interest rate incentives or penalties. And that's been thought about within Europe without much effect. And if those approaches don't seem sufficiently attractive, then we get into much deeper water. How about permitting or forcing the introduction of capital controls, at least as a temporary measure? Or to get really serious, should we even consider authorizing temporary trade restrictions as a kind of last resort against chronic surplus countries? Well, let me go on to another aspect. What about exchange rate fluctuations? And do we need a new approach? And is that more promising? Now, conceptually, right off, that would require some agreement about appropriate equilibrium exchange rates. And we might consider a wide band or zone around such equilibrium rates, allowing for uncertainty and permit the market to exert its own discipline. The central idea is that individual nations would direct their interventions and, if necessary, their economic policies to defending the band of equilibrium rates. An appropriate reserve currency and the provisions of international liquidity is a third area of concern in the design of an international monetary system. And again, for years, there's been no intellectually or theoretically agreed approach. Rather, we have had the practical approach, the use of the dollar and to some extent other national currencies as the pragmatic answer to an international currency. Now, the nub of the matter is not, as I see it, the common complaint that the international use of the dollar provides an inordinate privilege to the United States. In the last analysis, it's not in the interest of my own country to accentuate and extend our payment deficits at the expense of ever larger holdings of the dollar by foreign governments and central banks. We should rather want to be internationally competitive with a strong industry and restrained consumption. And surely the rest of the world wants the usability and flexibility afforded by the currency of the largest, strongest, and most stable nation, but there are limits to that desire. More than 30 years ago, the SDR was agreed and activated as a substitute for either gold or the dollar. And I have to tell you, I'm old enough so that I was there at the creation. I was filled with hope that a more coherent international system could be negotiated. But that hope has not been satisfied, nor is there today any clear path towards somehow mutating present currency holdings, whether they're dollars or otherwise, into SDRs. In fact, any future usefulness of the SDR as the main international currency will surely be dependent on its usefulness in private markets, and we are very far from that today. It is in any case a relevant area of study for the new institute. One, maybe even more than one, Asian nation may be tempted to seek, or at least tolerate, reserve currency status for itself and for its own money. I'm conscious that the currency issue then raises directly the question of whether we are ultimately aiming at a one-world monetary system or one based on 2, 3, possibly even more regional areas. Do I detect, and I hope I detect, a certain bias in the creation of the Fung Global Institute? In any case, is an important question with implications beyond the monetary system. All that is well beyond, and can't say an after-dinner remarks, but halfway after-dinner remarks. I am sure that all these matters should be and will be on the Institute agenda for years. And I'm also conscious that I haven't said a word about the makeup of the governing bodies of the IMF or other international institutions. I have not done so because, in my judgment, we will not solve the substantive issues simply by rearranging the seats at the negotiating table. But I do recognize the political implications and the need for a sense of legitimacy for any organized monetary system if it is to demand and command respect and allegiance. And that is why wider representation on the governing boards of the established international institutions is indeed in order. Now I want to end up where I started. The rise of Asia in general and China in particular is reshaping the international order. Hong Kong itself is a unique vantage point. For those of us in the West, it is a window into China and Asia, and it is also a window out of China to the rest of us. The function of a window is transparency. It connotes exposure, openness, a willingness to study and learn. And the new Fung Institute exemplifies those very qualities. So the Victor and William Fung Foundation has provided the concept and the resources. Andrew Shang has his shoulders to the wheel, providing both organizational leadership and much relevant experience, both here and beyond Asia. He is listened to with great respect around the world. So all I can say to all of you is Godspeed and good luck as the new venture proceeds. And I plan personally to stay around a while and watch it all happen. Thank you very much.